Howdy, Jacob here. Today we're looking at the company Ametek in the electrical equipment industry. Just under 40 billion market cap, just over 41 billion enterprise value. Current valuation of 30 PE, but growth has been mid to upper single digits CAGR over the last 10 years, with both operating and gross margin increasing, with return on invested capital probably the top two most consistent I've ever seen of any company, ranging from 9.5% on the low end to 12.3% on the high end of the last 10 years. That is, I honestly think, the most impressively consistent of any company. Probably definitely top three of any company I've ever seen. I can't think of one that's better off the top of my head. Or not better, more consistent. But 410 million cash on hand with 1.4 billion short-term debt. 1.9 billion long-term debt. That's a big figure. 1.4 billion. 1.4 billion. Okay. All right. Okay. No, that's fair. There last year, free cash flow was 1.6. 5-year average, still billion though. So made 1.1 billion on a 5-year average basis. So we're not concerned with this long-term debt, but that short-term debt, that means 100% of this year's money is going to have to be going towards that, or I guess you just refinance it. That probably makes the most sense too. They'll just keep, if you're looking at this, and if I say that it's close to a good price and you want to do a deeper dive, just look at when that's due. Keep that in mind when you do your own analysis and make your own investment decisions, please. So acquisitions is really going to be a huge focus of their free cash flow. I mean, we're looking at like probably 75% of their free cash flow the last 10 years has been going towards acquisitions. Their dividend currently pays out $238 million, and it's 0.6% yield. Not terrible. It's about 40%. No, way below that. It's like 25-30% of their 5-year average free cash flow. And buy back a little shares. Okay. They're not buying back shares every year, so hopefully they're buying back a lot of shares when the stock price is very low and the company's valuation is very cheap. Their debt has been pretty neutral, it looks like. So really, when you think about it, just a whole lot of acquisitions here. So companies like this, when they just make acquisitions and we see that gross margin and all their margins are kind of going down, that's kind of what I would expect. But a company that makes acquisitions that are increasing gross margin, increasing operating margin, we can say that this is although they're going to make acquisitions in the future that probably are going to change the business a little bit more than what you'd like to, for making, your original business decision prospects. But they've historically done a fantastic job of making acquisitions that are making the company more efficient. And so that's going to improve the margins that I see, even though it is due to acquisitions. So let's start making some assumptions on the revenue growth side. I think I probably wouldn't be surprised with maybe a 6%. I mean, it has been extremely consistent, so I usually don't like to go over, 18 is for a company that has good growth ahead of them, along with a very high return on invested capital. But this company has just is very consistent. I think that's kind of the art of investing that is going to put some people on a higher P and price free cash flow than somebody else. But here, maybe let's do 20 and 22, really pushing those up. Share change 1% would be about 400 million, but probably just going to offset stock-based compensation. Let's keep that flat. Dividends only 20 to 30%. They can definitely afford it now. They've increased it a little bit. I probably will just increase it with their revenue growth. And yeah, I think I'm comfortable with all this. So these assumptions: 6% revenue growth, 20 to 22% on the margin side, no share change, 18 PE at the end of 7 years, price free cash flow, current dividend increase at 6% a year for the next 7 years. We get to a price that still needs to fall 61% before you get the return that I'm looking for here. So I do think fantastic company. I'm I would definitely add it to your list of companies you definitely want to own. I think that obviously do your own research on it, but for me, I buy things based on price, not company, and I think this is a fantastic company. I want to own it, just not at the current price point. So hopefully you enjoy the video. Have a great rest of your day. Thank you.